Good afternoon this Thursday, July 21st. Just another fun, volatile day in the markets with thin volume and high volatility. Of course, today, early in the morning, we had seen the corn and soybean market push down to within pennies of their July 5th low and then tried a moderate bounce throughout the session after crude oil had stumbled some $5 a barrel and cut their losses in half during the day on Russia starting up the Nord Stream 1 gas pipeline again, making everybody think that world is going to be a good place. Well, as we got towards the noon hour, sometime around just before 1 o'clock, a tweet came out that in fact the signing for the safe grain corridor would occur on Friday and that plans were made for the UN security chief, the UN chairman, as well as officials from Ukraine and Russia would be in Istanbul to sign this safe grain corridor. Now, what happened right after that, before the close of today, we had seen the soybean market burst through its July 5th lows, but close back at them. We had corn taking a new day session low out, but held the July 5th lows and closed above early session lows on the day, implying a washout and a sell the rumor buy the fact kind of mentality. Even wheat prices tumbling some 40 cents from day session highs made during just before the noon hour around 11:30 when the European wheat values were closing up 30 cents on the day. We'd seen a 40-cent drop and then a recovery of 20 cents into the close. Does this imply that the $5 drop in wheat since this all started at the end of May and the $2 drop in corn and $2 drop in soybeans has run its course, that we already know that this is starting to happen, that we know that large grain supplies aren't going to be available for quite some time? There's only a few loaders that are capable of working out of Ukraine next week if they wanted to, and it's going to be, they figure, at least 6 months until potentially the volume of moving of grain through the Black Sea starts to pick up because they have to clean the mines out of the Black Sea region as well. So when everybody was thinking this was coming through and, oh boy, happy days are here again, cheap grain, it's not that easy. It's going to take some time, and we've already priced it into the veracity and the movement of the grain complex. Of course, we also have this rain that's going to finally be arriving in some of the driest areas of the Corn Belt for the first time in a considerable while. While these rains are welcome, they're going to be heavily washed, that they do make for planned precipitation amounts of at least an inch or more in some of these driest areas. Unfortunately, we're going to show you the weather models that show once we get past August 5th, the dryness and the heat returns. And so with the month of August being critical for soybeans, our soybeans, in fact, also making some kind of placement low on this, maybe sell the rumor, buy the fact on the reality of a Ukrainian safe grain corridor has been achieved after being conversed for now almost 2 months. So first, we're going to start with the weather. Here's this sought-after rain through Sunday, July 31st. They're hoping Nebraska through the dry areas of Iowa will pick up at least possibly an inch and a half to maybe 2 inches of rain here on this color corridor over here. And that's needed because this was put out today. The National Oceanic and Atmospheric Administration expanding this yellow area. Remember, yellow says drought development likely. They're concerning themselves how most of Nebraska now is entering the rest of the state along with Iowa and, Kansas, and there's not a lot of corn they really count on out of this production, but basically Nebraska is also concerning. Even look at how they're adding southwest and southern Minnesota. Remember, note that for Minnesota, most of the corn is grown in the southern third of the state, and look at how they're adding into this here as well, more drought expansion. So these rains are imperative that they occur in the coming week. Otherwise, we're not talking 177 bushel yield potential. We're talking something at 175 or less nationally, because will the East here offset the problems of the West? Not likely, because here's number 1 for corn, here's number 2 for corn, here's number 3 for corn, and here's number 4 for corn. Sorry, Indiana, Ohio, it's going to take a lot of production to offset what is potentially going to yank the national yield probably down to 175 or even lower. And that's going to get the carryouts back to pipeline near 1.3 billion. And frankly, that puts corn back up to $7 or more. We'll see. It's up to Mother Nature. Here is what the models are showing now today on the 11 to 15-day models. When you start July 31st through August 5th, they show the heat returning. And who's caught in this? Yep, southern Minnesota, Iowa, Nebraska really has the heat in this thing. Also, this is August 4th through Tuesday, August 9th. Thursday, August 4th through Tuesday, August 9th. Look where the heat stays. Minnesota, South Dakota, Sioux Falls, a lot of good corn country, eastern Nebraska, all of Iowa. This isn't going to be good for beans either. Dry pattern, a heavy dry pattern, stays more down in Kansas, Oklahoma, but Nebraska, South Dakota, Minnesota, Iowa, and even into, look at these areas of Illinois and Indiana. They're leaning drier. Of course, August is known for being drier. Now, another thing to be observing, along with the weather being probably optimum as best as it can be forecasted, the catch is, what is reality? The dollar, the U.S. dollar chart, is appearing to have put a chop in when we had that explosive CPI number where everybody thought we were going to see a 1% rate hike next week, July 28th. And, of course, the Fed dialed that back, said it's only 0.75%. Well, the dollar, after bouncing yesterday, turned back lower today as the EU banks, the central banks out of Europe, are going to raise interest rates for the first time in 11 years by 0.5%. So that shows other currencies finding increased interest rates, which then, of course, helps neutralize the dollar strength, because now it means we're not the only one out there raising rates. And it allowed gold to collapse to values that we've been showing on our newsletter for well over a month. I've been showing this monthly chart, and I've been showing this support at 1780 as the moving average support was coming up to kiss it at the same time. It hit that this morning and bounced. Now, whether this turns up significantly, we'll have to go through next week's interest rate hike, make sure it's no more than 0.75%, and see what they discuss afterwards. And likely we're going to go till September to another rate hike, and maybe this implies some potential basing and bouncing for the gold market. But this is the 2021 lows that are critical. And if the dollar is in fact topping and stalling, this is friendly for commodities and friendly for gold. Now let's go to the corn chart. Broke to a new low underneath last week's low, but we did hold the July 5th lows. Keep in mind that before there ever was a loss of Ukrainian corn, we had major trading resistance now turned support in the 555, 560 region. Corn has yet to want to even touch that. Here is the invasion date somewhere around here, and that seems to be where we continue to hold for support. We'll see if we can get through tomorrow. If the signing goes through and the grain markets do not want to drop much more on the anticipation of rain, it could be next week is the realization that the rain isn't enough, and that's the end of it. It's an interlude and not an actual pattern change of rain, rain, rain for as far as we can see. Then that gets us some kind of consolidative recovery bounce, something into August. Beans made an alternate low, did take out the July 5th low, but did close back at that value. And of course, extreme value we had been looking for was down here at the 1292 region, or that should be 1285, 1286. Today's low was something around 1294 before bouncing on the close. Again, this can still be a B wave, an alternate, but we cannot be falling under this value. We can still get some kind of recovery bounce. Maybe not as strong as a C that we would expect, but at least something back to the $14 range. But frankly, if that weather turns haywire in August like it did in 2003, well, we have to have 51 bushels to the acre on beans, because keep in mind, we slashed on June 30th another 2+ million acres. There's no room for error. When we get 50 bushel beans or less, you got beans back at $14 to $15. So it's all about August. So to sit here and try to be bearish beans, very difficult. A lot of chart support in here that implies maybe something is happening here and may take time, but ultimately we do anticipate a bean wave recovery. This is just a zoom out of the B wave decline. You can see how it did take out the prior low, but the close was still at it. But what this implies is we have to start being higher tomorrow. We would like to see a higher close tomorrow. But nonetheless, we are still in valuations that as the rain occurs and then we start looking to the future, if that rain does not continue, beans still have an improvement. Wheat, of course, broke 40 cents from the intraday high to today's low before bouncing into the close. Again, we can go back to pre-December, January, before there ever, and early February, before there ever was an invasion of Ukraine. You can see the raw value of what wheat fundamentals had in place. Plus, we've lost wheat since then. The European wheat crop has been lowered, along with the fact that India's crop is still going to continue to be lowered. So these values are very justifiable. 60-day cycle low probably hit, but it's no fun putting in a harvest low until some kind of rally can get into place. Also, we'll note Chicago wheat, same thing here. Here's December, here's January, here's February. Look at where those support, where those trading ranges were, and look at where we've bottomed at. Likely working a harvest low. December cattle, we did show this in the video on Tuesday. Trend line resistance we had just above 147. December cattle stalling, just a big nothing burger here ahead of the USDA cattle on feed report out Friday, and more importantly, the inventory data number as well. And the placements numbers will likely be low, probably picking up with all the cattle being liquidated in the Texas drought now. That's pretty much manifested here in the month of July. But still, December cattle longer term, we are optimistic, but you have to maintain that negative bias while they're under this trend line, because originally we were thinking this was an A, B, C collapse, but now this time is evolving. This is more like a small A, B, C. Now we're starting a wave 1, and now we're just a matter of this is a 2, and we're waiting for 3 to play itself out. Now the question is, does wave 2 get checked again before moving higher? We'll see. But we are optimistic cattle, but they are dead in the water on their price range for now. This is Eugene Grainer with Heartland Investor Capital Management. Hope you find this information useful.